So it's the type of thing where, I just want to take a moment to explain how important this divestment issue is. Okay, now I want to be clear here. I still want you, this isn't like an either-or situation. Everybody still, I want you to, ride your bike and, take the new LRT as much as possible. I want people to, travel locally, spend your tourism dollars in Ontario and Quebec. There's some beautiful, you don't have to fly away for your vacation. I want people to eat less meat, for sure, do all of those things. But if you're doing all those things, you're flying less, right? You're riding your bike or taking transit, you're eating less meat. If you still have money invested in the traditional stock market, the carbon footprint of your portfolio is going to dwarf the carbon footprint of all those different personal actions. So this is a study done by a firm called CoPower. CoPower, they issue green bonds. I'm going to talk about green bonds in a little bit, but they basically measured the carbon footprint of an investment portfolio. There are some assumptions built into this. Number one is that this is 100% stock portfolio. So normally it's a mix of stocks and bonds, but this is 100% stocks. And they split it up 50-50 between 50% Canadian stocks and then 50% global stocks. So a big issue is that Canadian investors, by default, right, often have a bigger chunk of their money invested in the Canadian stock market. Well, guess what kind of companies are in the Canadian stock market, right? When you look at the top 10 holdings, you look at the holdings, it's going to be oil and gas, it's going to be pipelines, it's going to be mining companies, and it's going to be bank stocks. And guess what Canadian banks are, right? Oil and gas, pipelines, mining companies. So by default, the Canadian stock market is very, very, very carbon intensive. And by default, most Canadians have very high exposure to the Canadian stock market. So what this means is that if you've got a 100K portfolio, $100,000 invested in stocks, obviously it dwarfs all those other actions. If you've got 500K, oh my goodness. And $1 million seems absurd, but I do a lot of retirement plans, and if your goal is to retire at age freedom 65, and never work another day in your life, $1 million doesn't get you super far, right? A lot of people for their retirement accounts need to have more than $1 million invested in order to just completely live off of their retirement portfolio. And in that case, there's an absurd amount of carbon footprint there. Now, I don't really like the having a child there because I don't want to discourage people from having kids. I mean, look at how cute these kids are, right? So I'm not saying don't have kids at all in this, but what I am saying is that, really when it comes to all these other actions, yes, personal responsibility and changing day-to-day actions, oh my goodness, yes, do those things. Very, very important things. But if you're doing all of those things, and your money is still invested in status quo, run-of-the-mill investments, if you're still doing your banking at one of the big 5 banks here in Canada, then unbeknownst to you until you saw this slide, your carbon footprint is way bigger than you realized. So really, I would argue that by decarbonizing your portfolio, by divesting from fossil fuels, it's probably the biggest thing that you can do. Now this is the really scary slide, okay? And this is as far down the rabbit hole as I'm gonna go, but I think this is one of the most important concepts for Canadians to understand. Because I've talked about how sustainable investing, you can make more money with it. This is the scary slide. This is if you do nothing, how much trouble you could be in slide. So how many people have heard of the carbon bubble? Is this a concept people know about? Okay, great. So I see a few hands, not everyone, so let me go through it a little bit here. But here's how it works, okay? So basically, we know that we have lots and lots of oil and coal underground. That now this idea of peak oil, peak supply, no, we have lots of oil, we have lots of coal, there's plenty of supply. The issue is that the value of all those proven reserves right now, right? If they were to dig up those fossil fuels and sell them to be burned, the value there is about $27 trillion, is what is currently the value of the fossil fuels that are underground here. Now, we know that if these companies execute their business plan, if they dig up those fossil fuels and burn that $27 trillion worth of fossil fuels, our climate is screwed. That we are just going to blow past all of our carbon targets. So according to the Paris Agreement on climate change, we have what's called a carbon budget. That if we're serious about limiting warming to like 1.5 degrees, or like 2 degrees, in that ballpark range, that we can't dig up and burn all of this carbon. That we have a carbon budget. And that our budget, this burnable carbon, is really only worth about $7 trillion. Which means that we're going to have to leave a lot of these carbon reserves underground if we're serious about meeting our climate change goals. Now, the ramifications of that on the stock market are huge, because right now, these proven carbon reserves are listed as assets on the balance sheets of all these companies, right? And if we as a society decide we're actually not going to dig them up, we're going to leave them underground, what happens to those assets? They're worthless. They get written off the balance sheets. And so it's kind of similar to what happened in 2008, 2009 with the real estate market in the US. Everybody remembers that, right? This is like when I was banging my head against the wall of my parents' basement, right? We watched this crash. I watched this crash happen on live TV. And that basically in 2007, the value of the real estate market in the US was about $13 trillion. And then just 2 years later, after the bubble popped, right, the value of all those homes was worth $6 trillion. So that bubble, that housing bubble, was about $7 trillion. And that was enough to start the dominoes to cause this like global financial system collapse. What we're talking about here with the carbon bubble is like 3 times as big. That this is a massive bubble. Now it's already started to deflate, right? Because this was done, a little while ago. I think this starts from about a year ago. And does anyone know how fossil fuel stocks have done over the last year? Not very well, right? So it's the type of thing where this bubble is already starting to deflate, right? And if we're lucky, if we're smart about this, that this is going to deflate gradually over time, that the economy and the markets will sort of reprice everything very gradually. It's not going to be sort of that pinprick. However, I want to be clear that if you're just invested in like run-of-the-mill investments, a big part of your portfolio is invested in companies that own those assets. And if we get very serious about climate change, and it's an if, this global geopolitical situation right now is kind of dicey. So I don't know if governments are going to get serious about climate change, but if they do, all of a sudden I can see those assets becoming toxic, just like the real estate assets. And I can see a massive devaluation happening over a very quick period of time. So, I'm all about the sort of good news story that yes, sustainability, ESG investing, you can do better, we can find better companies, we can outperform, but this is the risk side of the equation. That if you don't divest from fossil fuels, if you keep those inside your portfolio, you might end up holding the bag when it comes to these toxic assets. And I want to be clear that all of the smart money, so things like Canadian Pension Plan, Ontario Teachers Pension Plan, Alberta Investment Management Corporation, AIMCO, all these big pools of money are starting to catch on to this and are starting to shift their money. It starts towards the ESG side, and then now Canadian Pension Plan is doing their first carbon assessment. And so it's a little bit exciting, in terms of seeing that the smart money is catching on to this and it's starting to move in the right direction. My fear is that it's going to be retail investors. It's going to be the regular people who just own mutual funds, who never thought about what their investments were, who never made a decision to invest in carbon intensive assets, but just by default, that they're going to be the ones left holding the bag on this. And so that's why I'm on a huge mission to teach people about this and to show people the risk and then help people actually position their own money to avoid these types of risks. Of course, everyone's like, well, Tim, how much money am I going to make, right? They assume lower financial return by doing the right thing, when actually the opposite is true. Now, to be clear, my benchmark is the couch potato portfolio, okay? So this is a low-fee, portfolio using ETFs, exchange traded funds. If you own mutual funds, like the default setting for people is to like walk into the bank and buy mutual funds, your performance is going to be about 2% less, because those are the fees that you're paying to the bank and to the advisor that sold you, the salesperson that sold you those mutual funds. So just know that like if it's like you own like a mutual fund, I'm going to beat the pants off of that in terms of performance. This is like to the highest standard is that couch potato. That's like what the like smart investors are doing, the low cost option, right? And you know, the portfolios are still doing just as well, if not a little bit better. Obviously, with the fossil fuel free approach, you know, it's really going to be dependent on how the energy sector does, because we have no exposure to that sector. If as the energy sector has fallen, which it has over the last 5-10 years, you know, you can see that the portfolio has outperformed. If we get like a bounce back and like energy stocks all of a sudden go up, then obviously that would underperform. So just kind of like keep that in mind. You know, past performance is not indicative of future returns. That easiest pie portfolio, the ETF, just like it hasn't been around for more than a year. So I can't put performance up here just because it's so new. But again, you know, I expect it to continue this trend to do just as well, if not better. So again, I want to clarify that you do not need to sacrifice financial performance in order to divest. And then obviously, if the global transition keeps moving in this direction, away from fossil fuels towards the green economy, I expect my stuff to actually do even better compared to the benchmark than it has, right? And so again, I'm going to be very Canadian right now and suggest that we skate to where the puck is headed, right? That this is like performance in the era of Trump and Stephen Harper, that if we're serious about climate change and actually like move, like if we like listen to our students who are striking and like take this climate crisis seriously, then I would actually expect this to perform even better comparatively. So really that's it for me. A couple links here for you. You know, I've got my website if you want help with your personal investments. You're like, Tim, I don't know what you're talking about. I need help. You know, I can help you. You can sign up for a free consult there. If you just like want the nerdy ETFs and like the hyperlinks and the research for free, you can go to my blog, sustainableeconomist.com. You can add me on LinkedIn or Twitter or whatever social media you want to follow me on. Thank you so much for your attention.